biggest story on the news right now is the failing banks, that people were going to rush the banks. They're going to run out of money. The whole economy is going to crash down and the world is going to end. But what I bet a lot of people haven't thought about is, what does this mean if somewhere like Vanguard or Schwab or Fidelity, where people have all of their ETFs, their money market accounts, their brokerage accounts, can these type of places fail? If you haven't thought about your brokerage account, that's what we're going to talk about today. Can they go out of business? Can you go broke? Most of these people in the FIRE movement have all their money in ETFs and somewhere like Vanguard. So can Vanguard fail? It's a private company. They're not backed by the government. And if they did fail, what would happen to your money? We're going to find out right now.
Shut up and sit down.
Just in case you're new here, this is the Retirement Mentality channel. This is a place where I want to change your mentality about retirement, about how you think about money, about real estate investing. And I think people's idea of retirement, it just doesn't work the way that it used to. So I'm here to help you transition into the new way of thinking about retirement. If those things are important to you or of interest to you, consider sticking around, and I'll try to earn a subscribe and a like with this video right here. Let's start with the Silicon Valley Bank. Let's start with them. They're the ones that sort of triggered this whole concern that the banks are failing and they were going to go out of business and it was going to cause a run on the bank. So Silicon Valley Bank, just a little brief history here, just in case you don't know. I'm no banking guru. I'm not a financial planner. So I'm not giving any financial advice. I'm just going to tell you guys a little bit about what would happen to your money here. So first of all, Silicon Valley Bank was like a bank to big, huge corporations, Roku and Circle and places like that. So just Roku's somebody that everybody knows. I think they had $500 billion or something ridiculous in the account. So, and you've heard of FDIC insurance. That's the insurance the federal government gives to banks up to like $250,000. If you had 250K in a bank account, the government will ensure that you get that 250K back out. So these big companies that had all this money in the bank wasn't insured by the FDIC, so that's why they have to bail them out so that they can't go out of business. The way the banks work is you give your money to the bank and then they invest it or loan it out through car loans, through home loans, and they're using your money to give to somebody else. So your money that you give the bank shows as a liability on their balance sheet. They don't have the money in their bank. That's why when people run on the bank and everybody wants to withdraw their money, the banks don't have all the money in the bank because they've already loaned it out to me to buy real estate with. So I'm the reason everybody went broke. Just kidding. So with brokerage accounts, this is the main difference. With brokerage accounts, your money sits in that account and they're not loaning that out to somebody else. You're using your brokerage account money to buy an ETF, for instance. Say you're buying the Vanguard Total Stock Index, or VOO, which is the S&P 500. Those are two of the accounts that I have personally. And when I buy, even though it's called Vanguard Total Stock Index, it's an ETF of funds, all the stocks that exist. So it's a total stock market index fund, and they're not taking my money and then loaning it out to somebody else. That money sits in that account with Vanguard. I'm going to talk about, like, Vanguard doesn't actually hold that, so we're going to talk about more about that in a second. So there's a difference between the kind of insurance these brokerage accounts have versus the kind of insurance that your bank account has. The bank account has the FDIC insurance that we talked about was backed by the federal government. There's something called SPIC insurance that's used for the brokerage accounts. I'm not going to get too deep into that, but it's a special kind of insurance that's used for brokerage accounts. Okay, so let me break down one other difference between, you might have heard of someone like Bernie Madoff, who was an investment advisor that took people's money and invested it for them. And then it was a Ponzi scheme, and then he disappeared and poof, all the money was gone. So the difference with someone like Bernie Madoff, who's directly managing the money, and someone like Vanguard, where the money is actually held by a third party. So I can't even really explain exactly how it all works, but I know that Vanguard is basically has a custodian, or they're the custodian that handles the money. So let's just break down a couple of the reasons that they're probably not going to go bankrupt, and if they did, your money would be safe. One is the sheer size of the company. They have $8.1 trillion with a T under management. That's just a huge amount of money. They have 30 million customers in 170 different countries. To put it kind of into perspective, Someone like E-Trade, who probably everybody's heard about also, they have 420 billion with a B of assets that they manage, and they have only about 5 million customers. So Vanguard's way bigger. Someone like Fidelity, I think, is a little bit bigger. They have $9.9 trillion under management and 32 million customers, so a little bit bigger, but not much. But these guys are just huge behemoths. So the chance of them going bankrupt is small. Like that's what they said about Goldman Sachs. Obviously, I know also, but they're running on a different business model where they're not taking your money in and then reinvesting it out the way that banks do. I'm not a financial planner and I'm not giving financial advice in this video. I'm just, again, giving a little bit of history on how Vanguard operates and how safe your money is there. But take a lesson from that Bernie Madoff example. If you do hire somebody to manage your money, you don't want them actively managing and physically holding your assets. You want them to be a fiduciary. You want them to be a custodian. You want the money to go somewhere into some of their accounts, stock accounts, ETF accounts. You don't want them to just say, don't worry, I've got this investment with my uncle Leo over here and we're going to make a bunch of money on it. You don't want them actively spending and controlling your money. So keep that in mind if you do go out and hire a financial planner for your money. So the point of this is, A, Vanguard I don't think is going to go out of business. B, if they did go out of business, your money is still sitting in an account somewhere. You're in your ETFs. You have the amounts of shares. Probably if they were to become insolvent or go bankrupt, there are bigger problems in the world. And probably the value of your shares is what you should be concerned with, not whether you'll get that money back out. Your shares will all be there and they might be worth zero in the case that somewhere like Vanguard went out of business. But your shares are safe and they are there. So I hope you liked this video and got some benefit out of it. If you do, you know what to do. Hit that like button down there for me. Consider subscribing to the channel if you want to get more information like this or about retirement ideas and how to change your retirement mentality. And go watch this video next if you want to find out some common retirement mistakes that I think people are making when they're planning for their retirement. So go watch this one. I think you're going to like it.